Alright, let's get real. When it comes to trading in the financial markets, you're stepping into one of the most competitive arenas on earth. And from the moment you log in, you're bombarded. There's so much noise out there, it's deafening. You have a dozen tabs open. One expert on YouTube is screaming about a once-in-a-lifetime crypto pump. Another on a legacy financial network is warning of an impending crash. Your social media feed is a non-stop waterfall of other people's wins and losses, fueling a toxic cocktail of envy and anxiety. Charts with 100 different indicators, headlines designed to make you panic, TikTok gurus promising you can turn $100 into $1 million by next Tuesday. It's incredibly easy to get lost in this digital blizzard. So you have to ask yourself the most important question: what actually matters? When you strip away all the hype, all the get-rich-quick nonsense, what truly separates the consistent winners from the hopeful wannabes who inevitably blow up their accounts? It's not a secret indicator, it's not a magic algorithm, it's a set of foundational pillars. Let me break it down for you, piece by piece. First up, and I cannot overstate this, is risk management. This isn't just a chapter in a textbook, it is the prime directive of trading. It is the bedrock upon which your entire trading career will be built or broken. If you don't protect your money, you won't have any left to trade. It's that simple. Trading is a game of probabilities, and losses are a guaranteed part of that game. They are a business expense. Risk management ensures that those expenses are small, controlled, and never ever catastrophic. Picture it like seatbelts for your portfolio. You hope you never need them, but you'd be insane to drive without them. This starts with the golden rule. Never risk more than you can afford to lose. This means your trading capital is firewalled off from your life capital. It's not your rent money. It's not your emergency fund. It's money that, if it vanished tomorrow, would be painful, but wouldn't change your life. And on a micro level, this means using stop losses on every single trade. A stop loss is your predefined exit for a trade that goes against you. It's a decision you make when you are calm and rational to protect yourself from the emotional, hopeful person you might become when you're losing money. A common professional standard is to risk only 1% to 2% of your account on any single trade. On a $10,000 account, that's a maximum loss of $100. This isn't a suggestion, it's your financial life support. Next, let's talk about the battlefield inside your own head: mindset. You can have the best strategy in the world, but if your psychology is weak, you will fail. The market is designed to exploit human emotion. Your emotions are your biggest enemy. The two primary culprits are greed and fear. Greed makes you chase. You hit a few winners, you feel invincible. You start thinking the rules don't apply to you. You double your position size. You jump into a trade that doesn't fit your plan because you have an intense fear of missing out. This is how small accounts get vaporized. And its evil twin, fear, makes you freeze. After a few losses, your confidence is shot. You see a perfect A+ setup, exactly what your plan tells you to look for, but you hesitate. You're afraid to pull the trigger. Or worse, you're in a good trade, it pulls back slightly, and you panic sell for a tiny gain, only to watch it run another 500% without you. So what's the antidote? The best traders have mastered the twin virtues of patience and discipline. Patience is waiting for your specific setup, like a sniper waiting for the perfect shot, not a machine gunner spraying bullets hoping to hit something. It can mean doing nothing for hours or even days. Discipline is the muscle you build to follow your plan no matter what. It's honoring your stop loss. It's taking profits at your target. If you can stick to your plan, win or lose, you're already ahead of 90% of the people who try this. Your plan is your constitution. Discipline is your unwavering oath to uphold it. Now let's talk edge. This is a term that gets thrown around a lot, but few truly understand it. An edge is a specific, repeatable, verifiable advantage that, over a large sample size of trades, gives you a positive expectancy. In simple terms, you need a reason to take every trade. A real reason backed by data, not just a gut feeling. Your edge could come from technical analysis. For example, you might discover that a certain stock tends to bounce hard off its 200-day moving average. Or your edge could be trading specific candlestick patterns like a bull flag, but only when the relative strength index is below 50 and the broader market is trending up. The key is that it's a specific set of conditions, or maybe your edge is in fundamental analysis, the story behind a company or currency. Perhaps you have deep knowledge of the agricultural sector. You understand weather patterns and crop reports, and you can anticipate moves in commodities like corn or soybeans before the big institutions. Whatever it is, you must define your edge, and then you must prove it. Backtest it against historical data. Forward test it in a demo account. Collect the data. An edge without data is just an opinion, and opinions are worthless in the market. Never trade without one. And hey, don't ignore the news, but you must learn to use it, not be used by it. Major economic data releases, earnings reports, interest rate decisions from central banks, and unexpected world events all inject massive volatility into the markets. The amateur trader reacts to every headline. They see a scary headline, they panic sell. They see a positive one, they FOMO buy. They get whipsawed constantly. The professional understands that news is mostly context, not a trading signal. Your job is to use the news to inform your long-term big-picture view. Is the economy fundamentally strong or weak? Are we in an inflationary or deflationary environment? Understanding these macro trends helps you stay positioned on the right side of the market, so you're not panicking when things get choppy day to day. Know when major news is scheduled, and consider if it's wiser to simply be on the sidelines. Don't get caught in the crossfire. Next, the unsung hero of profitability, position sizing. This is arguably more important than your entry signal. It's not just about being right or wrong, it's about how much you make when you're right versus how much you lose when you're wrong. Small, consistent bets keep you in the game longer than big, reckless ones. Let's go back to our 1% rule. By keeping your risk fixed, your position size will change depending on the trade setup. A trade with a wide stop loss will require a smaller position size than a trade with a tight stop loss, but the dollar amount you stand to lose is the same. This mathematical consistency is what allows your edge to play out over time. And finally, the engine of your growth, review and adapt. You don't get better by just trading more. You get better by studying your trading. The market's always changing. It's a dynamic living entity. What worked last year might flop today. A trending market can become a sideways, choppy market. Your only way to navigate this is to be a relentless student of your own performance. Keep a trading journal. This is non-negotiable. Track your wins, your losses, and most importantly, your feelings. Why did you take the trade? Did you follow your plan? Were you feeling confident or fearful? At the end of each week, review your journal like a detective. Find the patterns in your behavior. You'll discover your strengths and, more importantly, your weaknesses. Learn from every trade and tweak your strategy as you go. The journal provides the data you need to adapt and evolve. Without it, you're just flying blind, doomed to repeat the same mistakes. So when you boil it all down, what really matters? It's these interconnected pillars. Think of it as building a fortress. Risk management is the impenetrable wall. Your mindset is the disciplined guard on that wall. Your edge is the unique weapon that lets you attack effectively. Position sizing ensures you use your ammunition wisely, and your journal is the battle log you study to become a better commander. Manage your risk, master your emotions, define and prove your edge, size your trades intelligently, and never ever stop learning. Everything else is just noise. Remember, in the marathon of trading, survival is victory. The goal in your first year isn't to get rich, it's to stay in the game. If you can do that while learning these lessons, you're already on the right path to building something that lasts. If you found this helpful, and you're ready to cut through the noise, do yourself a favor, hit that like button and subscribe for more no-nonsense trading insights. Thanks for watching.